Okay, let's talk about the global market. Of course, there's a big rally on, led by the US market. Here's Ekta with the world view.
Thanks, Anuj, for that. Well, I'll start with a lot of the news which came out over the weekend. So it's been a heavy weekend in terms of global news. China, in fact, cut its reserve requirement ratio for banks by 1% or 100 basis points. This news came out on Friday evening. But then that followed the US markets, and that's really where all of the data came out from. The Dow rallied over 700 points on Friday because there was a blowout jobs data. That's how it's been described in the US. US economy added 312,000 jobs in December versus an estimate of 176,000 jobs. Top this up with Jerome Powell saying that, basically hinting that the central bank could pause on rate hikes. So his quote should come up for you, which Lata mentioned as well, where there is no preset path for policy, and particularly with muted inflation readings that we've seen coming in, we will be patient as we watch to see how the economy evolves. Asia, Japan is surging around 3%, so things are looking good on the Asian screen, and we have an important cue coming in from the US-China trade talks, which are going to be held in Beijing today and tomorrow.
Thank you very much for that, Ekta. Well, the world is going to repeat what Jerome Powell said over and over again. The worry was not really about rate cuts. It was about the Fed's balance sheet, which, Powell himself said is more or less on autopilot. But over the weekend, there was this very interesting discussion between three Fed chairmen, one present and two past, Yellen and Bernanke. And it was during the part of that conversation that Jerome Powell gave us an updated version of what he makes of how the US economy will perform this year and how the Fed will adjust to that policy. Those were statements that set the market on fire. So listen in.
Financial markets have been sending different signals of concern about downside risks, about slowing global growth, particularly related to China, about ongoing trade negotiations, about what maybe let's call general policy uncertainty coming out of Washington, and among other factors. So, you do have this difference between, on the one hand, strong data and some tension between financial markets that are signaling concern and downside risks. And the question is, with those contrasting sets of factors, how should we think about the outlook, and how should we think about monetary policy going forward? Markets are expressing concerns, again, about global growth in particular. I think that's becoming the main focus, and trade negotiations, which are related to that. And I'll just say that we're listening carefully to that. We're listening with, sensitively to the message that markets are sending, and we're going to be taking those downside risks into account as we make policy going forward. There is no preset path for policy. And particularly with the muted inflation readings that we've seen coming in, we will be patient as we watch to see how the economy evolves. But we're always prepared to shift the stance of policy, and to shift it significantly if necessary, in order to promote our statutory goals of maximum employment and stable prices. We will be prepared to adjust policy quickly and flexibly, and to use all of our tools to support the economy, should that be appropriate, to keep the expansion on track, to keep the labor market strong, and to keep inflation near 2%.
Okay, that's a restatement or an updated statement we get from the US Fed. James Glassman, the senior economist at JP Morgan, joins us to parse the statement for financial markets. Good evening to you, James, and thank you very much for staying up for us on what's a Sunday evening for you. First up, how would you interpret this? That the markets should now come to terms with the fact that the Fed balance sheet perhaps is not on autopilot, and it may not reduce by 60 billion?
Yeah, I think in the early days, I think Fed policy was on automatic pilot because they had rates at zero, and they felt uncomfortable with the economy in good shape. They thought they needed to be somewhere higher. Two things going on. They're much closer to where they think the Fed funds rate should be. And, it's true, the balance sheet shrinkage has been on automatic pilot. I think the Fed has done that because they were so nervous that the market would have a difficult time as the Fed shrank its balance sheet. But I think now what they're trying to say is, well, this is all in the mix. They will be open-minded about it. And we don't really know how far they want to bring the balance sheet down. I think if there was some new problem in the economy, we would find much more flexibility on their part, even on the balance sheet. So the chairman is just saying, I think, really what's interesting is we've got very strong job news. The economy got a lot of momentum to generate this kind of job news. And yet, why is the Fed becoming more cautious? Well, because the inflation trends have been a little more moderate. So I think it was appropriate for the chairman to say they're going to be more open-minded. But I think this idea that's been percolating in the market that there's around the corner, the U.S. may be looking at recession risks, that makes no sense to me because monetary policy all around the world is still very accommodative, and the U.S. economy is growing faster than its long-run trend, and Fed policy is still accommodative. The real Fed funds rate is barely above zero. And so I think there's very little danger that the U.S. slips into recession. That's been the idea that's been driving the equity market. It's not that the equity market doesn't, the equity investors agree the U.S. economy is good now. They're always worried about the next step. But I think those worries are going to be dissipating, particularly when you see the kind of news we're getting with the kind of momentum here. So personally, I think this is all very constructive because it's telling you the central bank is being much more cautious, and they've got everything off. It's not on automatic pilot anymore. And they're paying attention to what the equity market's been doing. But I think this is going to be short-lived. I think the equity market's been driven by a faulty idea that the U.S. was on the verge of recession.
Okay.
James, hi, good morning. Happy New Year to you. Have the growth slowdown and trade war worries, those fears, have they sort of been put to end after the blowout jobs report that we got?
They may not be, but the truth is, I don't know why the worry about a slowdown is that much of a worry because the U.S. economy is at very low levels of unemployment. And so a slowdown would be greeted by the Fed as a favorable development. So I think essentially the job market news does quiet the worry about this. I'm not sure this is going to go away anytime soon. And I think, both on the trade front and on the economy, the trade front, we're starting to get a sense that both sides want to try to diffuse this tension. There's nothing constructive that comes from all these tariff threats. So I think both of those things are helping the mood, but we still have a long way to go. We are 14% below the peak that we reached in September. So the market has taken a pretty big hit.
Yeah.
I doubt the fears are going to go away quickly.
No, James, what Apple told us is also a very real threat. They have downed their earnings, and that can't be something the market can ignore. China, of course, has post that cut its reserve ratio by 100 basis points. But therefore, where does smart money go? Does it go to China at all after the kind of warning Apple gave? Or does it chase only developed markets after this jobs report? What's the pecking order for smart money?
I think we learned a lesson 3 years ago. Remember when everybody was worried about a hard landing in China? And then we find the government responding quickly. The reserve requirement is one. They're talking about fiscal stimulus. And shortly, the Chinese economy did better. So I think the smart money will be rethinking this whole idea that the global economy is slowing down. And my guess is it won't take much to get the risk on trade back in play again.
Okay, so back to equities, you think, for smart money?
I think so.
All right.
Yeah.
Thank you very much, James Glassman, for joining us and giving us your perspective on both China and the United States. So perhaps smart money comes chasing equities back. We did see it recede away from equities, and that's what James is talking about, that 14% fall from the highs for the U.S. market.